Benjamin Z. Meller, and in this video I'm going to answer the question, how does a global bond sell-off impact various sectors, and what can investors do to navigate through the turmoil? Well, good question. First, please don't forget to like and subscribe for more content just like this video. So, today we're diving into a very pertinent topic, especially considering the recent events in the global financial markets. Our exploration is into the widespread implications of a global bond sell-off and how it ripples through various sectors, notably banks, insurance companies, pension funds, and even the private equity realm. Now, we've all seen the headlines about the upheaval in the bond market, but how exactly does this domino effect take place? And what does it mean for investors, particularly those interested in establishing streams of passive income? Well, first let's talk about the banks. Banks are heavily entwined with bonds, and as borrowing costs have rocketed to their highest in over a decade, they're facing some steep paper losses. An example here is U.S. banks, where bond portfolios have seen losses close to a staggering $400 billion, an unprecedented figure. The devaluation of these portfolios can lead to a cascade of impacts on their stability and profitability, ultimately reducing shareholder value and potentially impairing lending capabilities. Second are insurance companies. Insurers, especially life insurance insurers, utilize bonds to back liabilities like pension obligations. The speedy surge in rates could prompt customers to liquidate long-term products, compelling insurers to unload bonds and possibly incur losses. This phenomenon brings about concerns regarding long-term solvency and the ability to meet obligations. Third is pension funds. For pension funds, higher yields on government bonds are typically a positive due to improvements in their funding position. However, a swift sell-off like what was observed following a crisis in the United Kingdom demands these pension schemes to prop up their hedging strategies with additional collateral, which might, in some cases, force them to liquidate less liquid assets, possibly at a loss. Next is private equity. Now, turning towards private equity, the sector which is generally associated with leveraged buyouts, the higher interest rates translate to more costly leverage for their investments and portfolio companies. It doesn't just slow down deal making, but also puts stress on companies to service their debt. When we sprinkle in inflation and economic slowdown, it's potentially a recipe for trouble. If you look at the corporate debt markets, amidst the bond yield ascension, the corporate debt markets, particularly in segments like U.S. junk bonds, have seen their average yields propelled above 9.3%, inflating the borrowing costs for companies and pressuring those with significant leverage or vulnerable financial structures. Given this multifaceted impact, how can passive income enthusiasts and investors navigate this complex scenario? Well, first, it's important to identify and mitigate risks. Begin by reassessing your investment portfolio. You want to identify assets that may be particularly susceptible to a continued sell-off in the bond market. Diversification is key here to manage and mitigate potential risks. Explore alternative investments. Diversifying your passive income streams through alternative investments such as real estate, dividend stocks, peer-to-peer lending, or even venturing into cryptocurrencies with a cautious and well-informed approach can be an apt strategy to hedge against bond market volatility. You want to look at rebalancing the portfolio. periodic rebalancing of your investment portfolio to align it with your investment goals and risk tolerance is imperative, especially amidst market turmoil. You want to engage in continuous learning. The market is ever evolving. Always strive to enhance your knowledge, understand market dynamics, and explore new opportunities that align with your investment philosophy and risk profile. In conclusion, the aftershocks of global bond sell-off, they permeate various sectors and bring about a myriad of implications for businesses, financial institutions, and of course investors. By being proactive, diversifying wisely, and remaining informed, you can navigate through this tumultuous financial landscape while safeguarding and potentially growing your passive income streams. And the best part is, you don't have to do it alone. You can join the Benjamin Z. Miller Investor Networking Group, and you can meet investors from around the world. Just look for the Benjamin Z. Miller Investor Networking Group, or just send me an email, ben@benjaminzmiller.com. I hope that helps, and I wish you good luck with your investing.